Well, Powell tells us it's premature to expect a pause and rates are going higher. We have some way to go, he says. Now, we've seen an ugly close in risk assets. The US dollar is shot higher, but the Fed aside, there's so much more going on in markets. And Blake and I discuss all of these factors and more in the trade-off. Well, hello again. My name is Chris Weston. I'm head of research here at Pepperstone, and I'm going to be joined by trader extraordinaire, Mr. Blake Morrow from Forex Analytics, and we're going to be discussing all the thematics that are taking place, all the themes, the flows, the setups that are shaping my world, Blake's world, and your world as well. So without further ado, let's bring the great man into the programme. Mr. Blake Morrow, fresh from trading the FOMC. It's been a wild day. And it'll probably continue to be a wild night as we go through Asia at the moment. How are you feeling?
I feel like I got whiplash a little bit today, to be honest.
But you like that.
It was, I needed a little bit of a head brace. And, I positioned myself fine for the end of the day, but man, intraday, it really, we're going to talk about the FOMC, but I'll tell you, it was some whiplash price action there. So
yeah, no, it's been pretty wild. I think we probably might as well just jump straight into it. Let's go into topical thunder. I want to talk to you about the Fed meeting. Well, Blake, I think it's quite interesting. Some of the news flow that we're seeing in Australia at the moment is that 5 lions have escaped from one of the local zoos. So I think that's sort of occupying a lot of people in Sydney's minds at the moment. I haven't been asked to go up there and try and tame them at the moment, but I think that's something that's made me laugh, obviously.
Don't they know you're a ranch hand? I mean, come on.
I'm good with cows, mate. I'm good with cows, but lions, they're a whole different beast. Anyway, let's talk about the Fed meeting because that's what it's really capturing. I think Powell's done a pretty good job. Now, everyone's going to be saying, Chris, what are you on about? But the guy has managed to pretty much tell us that he's open to slowing the pace of rate hikes to more conventional paces, which was this step down that people have wanted to go. But at the same time, he's managed to tighten financial conditions. So I think he's done a pretty good job in that situation. The market initially got pretty excited and risk was very much put on when the Fed came out and said that, we've seen this cumulative 370 odd basis points or whatever, the biggest pace of tightening since 1980, which was when I was born. But at the same time, they're looking for a bit of a pause and reflection, and they knew that this takes some time to work through the system. The market said, well, hang on, that's positive. They put on risk. We saw dollar sellers, real rates move lower, and the NASDAQ went for a bit of a run. But then as soon as Powell stepped up to the mic, he managed to reverse that and more. And it was a really ugly close that we saw coming through in markets. So, he's tightened financial conditions, but also told us that he's open to a reduced pace of hiking going forward. So, what did you take out of the meeting?
Well, it was really the comments that that their expectations of rate hikes are going to be higher than previously expected in the month of September. Yeah. So that means whatever they were thinking in September,
4.6 they are now thinking in September was the median number. So
yeah, and now they're thinking it's going to be higher, and that is what took the market down. Yeah. And I was actually doing a live analysis with our group because I had my business partner visiting from Athens, Greece. So he was in my office. We did something special. We don't normally do this. So I wasn't actually listening to the presser. I was actually just looking at headlines and looking at price action, but I saw that price action reverse. I saw the headline and I'm like, oh man, this is going to get ugly. And I went from a profitable positions to a negative position, turn around, and then got into profit, by the end of the day, which was fine. But that is where that reaction came from. Now, we have to just think about what they did is basically if you were in the camp, which you have, and we're going to talk a lot about positioning and where the market was at, where it was what it was thinking going into this, that there was going to be some sort of pivot. There isn't, and that is a fact, and that is what the market is looking at right now, and that's why we saw the big reversal.
Yeah, so, I think you're right. Look, the terminal rate, which I talk about ad nauseum in the show. It went on a bit of a whippy ride last night, but now we're sitting about 5.08%. So the terminal rate has pushed above 5%. The Fed have told us they want to. Basically, I think the mantra is that we're going to see a slower pace of hikes, but they're going higher and they're going to be up for longer. And that's something that we had to contend with. Powell wants to see risk assets lower, I think is my mind. So that's kind of the issue that markets had to contend with. So whippy ride, and we've seen some violent moves.
Well, let's talk about the FOMC, because I think there's even more violent moves in store come to the end of the week. And I want to think about what our playbook is going into this, Chris, because obviously, as we've been discussing here on the trade-off quite a bit over recent weeks and recent months, actually, the data does matter. And non-farm payroll is one of those standout pieces of data in the U.S. where we have employment that continues to be sticky. Like inflation, it's strong, and it's persistently strong. And the market's looking for 200,000 jobs to be created, and we have unemployment rate might tick up to 5.3%, but all in all, the data is still expected to be fairly strong. So if it is strong, and we do have this stronger release on Friday, think about the damage that could be done, especially in the FX market and S&P as well, or broader equity markets, especially with the reversals that we've seen. So what's going to be your playbook? Because for me, I'm looking at currencies like, I look at like some of the commodity currencies. They're not, we got nice rallies off the bottom, especially with the Aussie and the Kiwi. And the Canadian turned the corner a little bit, but they really haven't rallied that much. Yeah. So are we in store for new lows? That's kind of what I'm looking at.
I think what are you thinking here? The way I like to frame this is do we get a bigger risk rally on a downside miss, a weak number, or do we get a bigger rally in the dollar and risk a more defensive play? Do people take risk off the table if we get a strong number? Where does the bigger move come? It's a hard one to answer that. I mean, the market's desperate for a pivot, but now that we've seen the Fed coming out and obviously going the opposite way, it probably feels to me that there's bigger downside moves in risk assets, a bigger upside move in the US dollar if we were to get a strong number than the relief on a weak number, because the Fed, it's going to take them a bit longer to change. So, I think the risk is for the market is if we get a number, let's say above 300,000 on the payrolls, and we were to see the unemployment rate tick a little bit lower, depending on what happens with the participation rate, of course, and obviously wages is a factor. And then I think in that situation, dollar yen breaks out, the dollar goes for a run, we see real rates moving higher, and I think the NASDAQ probably finishes, let's say, 3% lower in this kind of volatility regime. But a weak number, a weak number would have to be something less than 100,000. And then I think then you would get a nice risk rally, but it's still not going to change the game. The JOLTS report earlier in the week, everyone was expecting and hoping that we were going to see job openings decline and see a cooling of the labour market. The opposite was true. So if you get a strong payrolls number, a large increase in job openings, and the Fed just have to continue doing more and more effectively. And I think markets respond. So everyone at home should be asking that question. Where do you see the bigger reaction on a beat or a miss to risk assets? I think that's the question you've got to ask yourself, right?
That's a great question.
Yeah. Another one, we've got CPI next week, and that's going to be, it's a huge one. The market's expecting 8.1% on the headline, 6.6, 6.5%, so an unchanged reading. Again, why does the Fed take their foot off the accelerator when their job's not getting done? What's the point in the Federal Reserve if they're not actually achieving their mandate? But anyway, look, Blake, this is more up your alley because we've got the midterms next week. And one of the concerns I have, if we go into the midterm situation, is that the US is going for a recession. There's a high probability that the US goes into recession second half of next year, probably back of the envelope calculations. Now, if we have a look at what's going to happen, every seat in the House is up for debate, 100 odd seats there. 435 seats in the House. They're all up for, and the Republicans are expected to win that very comfortably. In the betting market size, it's not even a debate there. The Senate's another situation. We've got 35 seats of the 100, which are contestable. And again, the Republicans are expected to do pretty well there. So that if you look at this is not my view, so please don't hate me on this, Democrat supporters. But this is the probability that you can get on Predictor or betting sites that the Republicans are going to control both chambers of Congress, and of course Biden there, whereas in the White House. How are you seeing this? And most importantly, I've got my own views on this, but I'm going to ask you, having to live and breathe it in America, do you think this has the potential for any kind of volatility in the dollar and markets?
I do, and it's funny when we're putting these topics together, And, here over the last, few minutes, I was like, oh, crap, we're talking about this and I got to talk about that. And this is going to kind of run into the next subject matter as far as positioning and sentiment goes. But the fact of the matter is everybody is expecting for us to rally following the midterm elections. And I think that is, seasonally, that is a big issue where the market is expecting us to rally. And yet people are expecting that. And we are facing a situation where the Fed is not going to let off the pedal. So with that being said, no matter how things shake out during the midterm elections, I think you have to be sell rallies no matter what. I mean, it's just, even if the market does rally on some sort of, let's say the Senate is not taken by the Republicans and maybe it's by the Democrats, and the market, coincidentally rallies, I think you got to use that as an opportunity to sell into because of where we're positioned in the marketplace. But, I think the midterms do play into individual stocks more because you start thinking about like, oh, do I really want to be buying marijuana stocks, based on who controls the House and Senate? That is, what legislation is going to be passed. But for the broader markets, I think you still have to sell rallies. That's my opinion.
The way I think that we've got to take it from a fiscal perspective, as the US goes into a recession, they're going to need some fiscal support. And if you've got Congress being controlled by the Republicans, and Biden can come out and say, I want to have a stimulus to help people out. I know he's constrained by high inflation already. The UK can be testament to that. But, effectively, it's not going to make its way through Congress. So there's going to be no fiscal support. So it's all down to the Fed. The other thing that we need to think about probably for next year is this old chestnut, the debt ceiling and the continuous resolution and government shutdowns. The Republicans are peddling this idea of fiscal prudency and Biden can come out and say he wants to push this through and increase the debt ceiling. But again, it will probably get poo-pooed. So that could become an issue next year as well. So you've got to think about fiscal support. You've got to think about the debt ceiling for next year. That's what I'm really looking at there.
Well, and like I said, these two segments kind of coincide and work together because I really want to talk a little bit about positioning in the markets due to seasonals. And, midterm election is like, it's a big one. I think the quote was, for the last 100 years, after every midterm election, you've seen a rally for the next, several months. And then this is something else. I wanted to read this from the Stock Traders Almanac. November kicks off the best 6 months of the year for stocks, which tells investors that price return for the S&P 500 from November, that would be like today, through April has recorded the highest average price change of any rolling 6-month period, according to the Stock Market Traders Almanac. And you got the Santa Claus rally, you got midterm elections.
Mate, I've told you, don't. I hate that Santa Claus.
I know, but I'm just saying, I'm throwing it out there, Chris, because people position around these things regardless. It's like emotional investing, which, whatever. It is a thing. It is a thing. It is a thing. And the fact of the matter is, people just got their butts handed to them today following the Fed. And now, in the face of a more aggressive Fed, I know other central banks are starting to be less hawkish.
That's right.
And I hate to say, but do they really matter? But do they really matter?
I think they're very specific, aren't they? You can play the pound against the crosses, but if you put the dollar in the equation, then you're obviously trading the Fed.
Yeah, right. Okay. And so if you're trading any of the indices, you're obviously going to be influenced what happens with the S&P and some of the bigger US indexes.
No doubt.
So
unless
I guess
the question
China,
is, unless you're trading the Hang Seng.
China might be an exception to the rule. That is correct. It just goes straight down. It doesn't matter how you position yourself, right? I'm just kidding. I'm just joking. I'm joking about that. But jokes aside, though, I mean, you think about the seasonality aspect of what everybody's trying to do and see how the market's performing. What happens if seasonality doesn't work this year?
Let me
have any thoughts on?
So I was going to say, I've just been really rude and cut you off there. Apologies.
I was
looking at this the other day because we do get a few calls about seasonals and bringing them more into play. I will say that in the last 10 years, last year the S&P fell 0.8% in November, but every year after that point, for 9 years in a row, the S&P rallied. So, if you've got the form guide, this is the best month to be long stocks. I know last year was the outlier, but every year in 9 years for November, the S&P's been higher. Conversely, actually, this is, I think, the worst or the second worst month for gold longs. Gold has averaged a loss of 2.9%. 2.5% in November, so it's not a great time for gold. I think that's probably a good play. And the dollar tends to do pretty well. An average is in November about 0.84%, and it's rallied every year for the last 10 years, except in 2020 and 2018. So, there is some strong seasonality in November, and that's something that, maybe you do need to be cognizant of. I think you make some good points there.
All right. Well, there you go.
Anyway, let's go into that's the setup. Let's have a look at some of the charts that are on mind. Blake, let's bring up the chart of dollar yen. We talked about, I've talked about this time and time again, that dollar yen's really affected by terminal rates in the US and also what's happening in real rates, and you can also say 2-year treasuries as well. But look at those wicks that we've been seeing. This is the daily chart. I mean, you can just use it for an oversight just to get a sense of how people are behaving, the sort of bids that are coming into the market. Yeah, we tested that September, that big move that we saw, the intervention high that came through in September. Yeah, we've just found really strong buys. Look at the size of the wicks that you're seeing on those candles that are coming through. There's real demand to buy dollars into any kind of pullback in the last few weeks. I know that's fighting a situation where the Bank of Japan potentially could come out at any stage and intervene. But for me, I think you want to be buying rallies through 148.80 as a momentum play there. Obviously, there's an art in buying breakouts. But you look at the support in dollar yen that we're seeing on any kind of pullbacks. How are you reading this one?
Well, I'm reading it as long as you're above 146, it's hard to be bearish. And I know last week, I played the dollar yen to the short side till it got to 146 and change. Then I wasn't short anymore, ahead of the FOMC. But I think you got to respect that support. While you're above it, you've got to at least have that bullish bias as you get close to it, Chris. And it's a hard one to play. And I have been on the short side. I've been playing it and making money on the short side, but it's not easy. And that means that as we consolidate at these higher levels, you have to respect that, and that's a fact. Now, if we start to see some of these other yen pairs, you start looking at like the sterling yen, the pound yen, or the guppy, I like to call it, Chris. That one might even be showing us a false breakout. And you're seeing like some of the Kiwi yen reverses some pretty key levels. Maybe the yen, if you want to play it on the long side, maybe it's not against the dollar and it's against some crosses instead. Yeah,
I like buying strength. There might be a scalp if we got into 148.80. There might be a scalp on the back of that, but. If it breaks through those levels, I think we go into 150, and then of course that's when you're going to be watching those headlines for intervention. So just be a bit careful above 150. But I think we get a break of those highs, and then I think we get a nice run into 150. I think that's probably the way I'll be looking at that.
There you go. All right. Well, I'm going to take us over to the Aussie New Zealand, and we're going to dig down under for this Aussie dollar. And I'll tell you, Chris. Some of you probably remember this chart. The last time I brought this to your attention, and I know Chris talked about it in between times, and he was looking for a short, I believe, Chris, a couple weeks back, and it worked out fabulously. But here we are, and you can see where we made those peaks, and we made peaks in the RSI. And every time we made a peak in the RSI, we peaked in price, and we rolled over. It's been a great short for me. I've been playing it on the short side. However, I am looking for a counter trend move, and I'm looking for a bounce after a nice, revision to the mean type of trade. We get to the golden fib, which is the 161% extension. So sub 109, I actually have some bids down below where we're currently at. I'm hoping I get filled. If I get filled over the next couple of days, I'm going to take it for a ride. I like it that the RSI now is oversold. You can see it down below. Being oversold, we've had such a big move. I'm looking for a counter trend bounce back up towards the 200-day moving average, back up towards 110, maybe even a little bit higher than that. What are your thoughts on the Aussie Kiwi here?
Fundamentally, I mean, I'll tell you exactly why it's done what it's done. There has been divergence. It's been a beautiful trade from a fundamental perspective. I mean, the RBA have obviously were the first ones to pivot, and we did it on the 8th of September with Governor Lowe speaking at the Annika Foundation. And really since that point, then the RBNZ came out and they were obviously concerned with the currency weakness. So you've seen a central bank divergence trade 101 between these two. I mean, we have just saw today that supermarket workers in New Zealand have had their wages put up 12%. Again, that's inflationary. So I don't like being long the pair at the moment. I don't like it fundamentally. But I will give you the fact that it's oversold. So I like the fact that, if you are looking at this, it's just an oversold correctional rally, and nothing more than that. I'd be looking to sell rallies myself. But I think, you wouldn't get much more in this market than the 200-day moving average. I think it's done what it's done because of a reason. People are looking, maybe people take some off the table, and that gives you a counter trend rally. But I think everyone's going to be looking to sell into it.
Yep. Great idea.
All right. Let's go.
That's you. And that's to you, Chris.
So, momentary lap of concentration there. It happens when you get as old as I do. But last week I talked about play of the day, not trying to give myself a bad pat on the back because I get a lot wrong. But we talked about last week about selling the NASDAQ into the top end of the range. It's worked quite well. The question now is, Blake, we've got this horizontal support levels, which you probably see much better on the hourly chart. Of course, we're, this is a weekly show, so we're going to keep it to daily. But you can see the rhythm, the structure, the feel of what's happening in the NASDAQ. Today was an ugly session. We came off, I think, about 4.7% intraday reversal coming off that initial move that we saw from the statement, and then obviously Powell smacked it back down. We break through this horizontal level. We go into the swing levels that you saw, October lows, potentially make new lows here. Do we buy into the range lows? Do we buy into the lower Bollinger Band? Perhaps. Maybe there's a scalp there, but it feels heavy, doesn't it? It feels dark. Where do we go from here, Blake? I want to ask you.
Well, the problem, and I don't want to allude exactly to what my play of the day is, but it plays into the hand of what you're showing here. The NASDAQ has been the underperformer. It just has not performed well. I think the market's closing on these lows really caught people wrong-footed, so positioning is off here. Yeah. And that's scary, because that's scary for tech stocks. And we've chewed through the earnings season. They weren't terribly horrible, but I think there's things bigger than earnings right now, and that happens to be the Fed. And while the Fed's got their foot on the pedal, and the pedal is to the metal, the downside in the NASDAQ it does seem like the path of least resistance at this point. Yep. Fresh lows seem right around the corner. Then we're going to be buying it for Santa Claus rally. Chris, Santa Claus, he's coming to town, buddy.
I think we're going to get. I've got to be open-minded, and it may not happen, but I think it does feel like there's a very high probability that we get a Santa Claus rally. What I will say about this is don't fight the Fed means continue to stay short and sell rallies. Powell does not want to be the man who is remembered as the guy who lost a 40-year inflation battle. Price stability is his mantra. He does not want to go down as the Arthur Burns. He wants to be known as the Paul Volcker, and that's his legacy. So he is going to go after this market, and that says don't fight the Fed. It still suggests staying short for now, but I wouldn't be surprised if we were to see a year-end rally.
All right, Chris. Well, I'm gonna turn your attention to the poo-poo peso dollar mex. And I've gone on and on and on how I love buying Mexican pesos. I love the trade. I love the fact that it has not rallied with risk off. But guess what? Today, Chris, we really pivoted and really rallied off some key levels of support. You can see,
look at the candle.
Some of that support. What's that?
Look at the candle, the daily candle.
It's a gnarly looking candle. And you can actually go back all the way to beginning of 2021. I didn't take this chart. I didn't want to squish it too much to where it was unreadable, but go back to the beginning of 2021. This 1950 level, 1950s, 60s, very, very critical support. We bounce like a bat out of hell, and we are seeing some risk off. I'm going to be poo-poo on the peso for now until we get back to the 200-day moving average, maybe up to that range, that wedge top. But I am playing it, and I'm going to talk my own book. I did short pesos today, so I bought dollar mex. I bought it on that dip, and I'm playing it to the long side from here, Chris. So what are your thoughts?
Well, I think anyone who's over 45 years old, hit up the early Urban Dictionary to understand what this word gnarly means, because I think this is Blake revisiting his youth when he was hitting the skate parks and gnarly man, but maybe I'm sort of struggling on that one. But I like it higher as well. I think, you are fighting a carry position because the MEX, I think, next week we've got CPI in Mexico, and that's expected to be another big number. You've got interest rates, 9.25% in Mexico. That gives you that level of carry, which is so nice against the pound, the euro, all these kind of places. Certainly the pound with negative real rates. But yeah, look, I mean, it's had a nice move. That candle is just showing huge bids coming back into the market. Up she goes. The question is, do we see the follow through? Buy stop orders above the market, take the ensuing move, and you've got a bit of momentum play there as well. So yeah, I think it probably trades a little bit higher. Fundamentally, there's a lot to like about Mexico though, so that keeps me a bit sanguine. But yeah, I think you trade the momentum rather than anything longer term. So we'll see what happens. Anyway, let's go to play of the day. Let's see the plays that are on front of mind. I'm going to bring up gold, Blake. If you think that the Nasdaq's probably going to go down to those lows, we break that support level we're kidding on now. And, every day is a new day in the market. We could see the market look at the Fed meeting with a fresh mind. We'll see. But what I think is really interesting, and this is a setup, is this horizontal level of support levels you can see around that sort of 1622 level. That's a massive level for the gold market to be looking at. Do we come down? There's probably a scalp long. You could probably pick up 20 pips or so on the back of that. But my base case is that we probably break that. The dollar looks good at the moment. The risk look like it's probably trades lower, and I think gold takes that down. So, yeah, while you might get a scalp off that support level because it is a major one, if we were to see a break of that, then I'm short, and I think we probably trade down, to the figure, perhaps a little bit lower than the figure. You probably see a stop loss run through 1600. But that's the one that everyone should be watching right now, the gold market. I think we go down to test the support level. Maybe there's a scalp there, as I say. But I think a break of those lows, and I'm short, and I think we're probably trading to 1600, perhaps lower.
All right. Well, Chris, thanks for that. Gold, because tell you, without it getting above 1700, you just got to keep looking lower. And man, it's scary for anybody who's long. I'm going to take you over to FAANGs. I'm going to do something a little bit different, Ooh. Chris. I know FAANG. Yeah, we are breaking levels we have not seen since, it's a new low for 2022 for this, I guess you can call it mini index, I guess.
Are you trading this for an ETF? How are you doing it?
No, I'm not. What I'm going to show you is I want to show you the FAANG, just as we closed at lows for the year. There are obviously different stocks that are involved in FAANG, but if you take like two of the weakest stocks, which would be Google, and you take Google and Amazon, Amazon, the scary thing is that's a consumer-driven stock, and that really kind of shows you how the consumer is probably faring from anything that's outside of food or energy. You look at Amazon, and it closed at new 52-week lows. You've got Google, same thing, but it's closed on 52-week lows, but that's like ad buys. That's corporate ad buys. So that is a little scary from the economy point of view. But even if you look at Apple, Facebook, or Meta, and Netflix, they all still look pretty gross. But keep an eye on Google, keep an eye on Amazon, and definitely keep an eye on the FAANG mini index because it looks like a good short.
Yeah, okay. Yeah, I think Amazon making up a large portion of the discretionary basket. There's probably a trade long energy, which looks like it might want to break out. Short discretionary as a play on Amazon there. You can do that via ETFs. It's an interesting one there. Anyway, obviously, if you've stayed and watched this whole show, thank you very much from the bottom of our hearts. As always, give us a like. We love that. We always do really well, and it gets the show out there because we want many people to watch it as possibly we can. Leave a comment. We always get loads of good comments that we always read. And we'll try and get back to them as many as we can. But thank you for watching, and we'll see you next week for more of the trade-off.